Understanding bond yield, a financial history perspective. Have you ever wondered what bond yield really means and how it fits into the world of finance? Let's break it down together. A bond yield is essentially the annual return an investor expects from holding a bond until it matures. This yield reflects the income generated by the bond's fixed interest payments, known as coupons, in relation to its current market price. It also considers any gains or losses if the bond is bought at a price different from its face value. From the perspective of the issuer, the bond yield indicates the cost of borrowing money. For investors, it signals the potential return and risk associated with the investment. Historically, bonds have played a key role in financial markets. They allow governments and corporations to raise capital by borrowing from investors. As the bond market developed, the concept of bond yield became essential for measuring the profitability of lending money through bonds, especially since bond prices fluctuate based on market conditions. There are different types of bond yields that are important to understand. The coupon yield, or coupon rate, is the fixed annual interest rate set when the bond is issued. This rate is calculated by dividing the annual coupon payment by the bond's face value and remains constant throughout the bond's life. Next, we have the current yield, which is calculated by dividing the annual coupon payment by the bond's current market price. Since bond prices can change over time, the current yield will fluctuate inversely with price. If the bond price rises above its face value, the current yield decreases, and if the price falls, the current yield increases. Another important measure is the yield to maturity, which represents the total expected return if the bond is held until it matures. This measure accounts for all coupon payments and any gain or loss if the bond was purchased at a price different from its face value. Yield to maturity is widely used to compare different bonds. The relationship between bond price and yield is inverse. When bond prices rise, yields fall, and when prices fall, yields rise. This relationship reflects changes in interest rates, inflation expectations, and perceptions of credit risk. The development of the bond market over centuries has been closely linked to economic growth and the evolution of financial systems. Governments issue bonds to finance deficits or public projects, while corporations issue bonds to fund expansion. The yields on bonds of different maturities create the yield curve, which plots yields against time to maturity. This curve serves as an important economic indicator, signaling investor expectations about future interest rates and economic conditions. Historically, bond yields have been influenced by various factors such as inflation, monetary policy, and credit risk. For instance, during periods of high inflation, bond yields tend to rise to compensate investors for the loss of purchasing power. Conversely, in times of economic uncertainty or recession, yields often decrease as investors seek safer assets like government bonds. Understanding bond yields is essential for making informed decisions about buying or selling bonds, assessing risk, and managing investment portfolios. For issuers, yields determine borrowing costs and influence decisions about when and how to issue new debt. Bond yield is a key concept in financial history and markets, reflecting the interplay between borrowing costs, investor returns, market prices, and economic conditions. It has evolved alongside financial institutions and remains central to the functioning of modern financial systems.